Hi, I'm Amy DeGangi, and today I'll be telling you about the top performer of the Dow 30. This presentation will provide you with an overview of my analysis, an understanding of the process of elimination, highlights of the top performing company, and an industry comparison. Because of time constraints, I'm not able to include all the factors I considered when analyzing these companies. So I've provided you with a breakdown of my assessment. One of the first things that I looked at was each company's overall risk. This was defined by their beta and their relative volatility. Next, I moved on to their capital structure and liquidity. For this, I looked at things such as their current quick and cash ratios as well as leverage ratios. I then moved on to their asset management and their profitability by looking at things such as their return on equity, their return on assets, and their dew point analysis. I then looked at their market performance by looking at things such as their P/E ratios and their earnings per share. Because these 30 companies are well established and they're traded at high volumes, it's very easy to rate them in accordance of their risk and return. For this reason, I have broken them down into 4 different classes. Class A belongs to those companies with the lowest beta, and Class D belongs to those companies with the highest beta. They also have some other undesirable traits, such as a negative economic value added and low return on equity. Because those companies in Class A that have the lowest beta have the highest return on equity, I continued forward with my analysis with only these 10 companies. In order to look at these 10 companies' performance in some more depth, I looked at their leverage. As you can see, I created an efficient frontier for those belonging in Class A. Their risk is defined by their equity multiplier, and their return is defined by their return on equity. As you can see, 3 of these companies lay along the efficient frontier, offering the highest return for a given level of risk. That makes it really obvious that IBM, Johnson & Johnson, and McDonald's are the top performing companies. So for the rest of my analysis, I moved forward with just these 3. I then wanted to get a better idea of where their return on equity was headed. So I looked at the trends over the past few years. Normally for an analysis, you can look at the past 5 years to detect trends. However, I included the past 9 years because I wanted to capture their performance during the economic downturn we took in 2007 and 2008. This graph illustrates 2 important things. Most importantly, Johnson & Johnson's performance and their return on equity has been trending downward over the past 9 years, while McDonald's has been trending upward. The second most important thing is that though McDonald's was hit harder during the economic downturn, it performed well overall. As you can see, Johnson & Johnson's return on equity was staying about the same before the hit, and after the hit, it trended downward. While McDonald's was hit harder, after the hit, their return on equity was higher than before, and they continued their momentum, gaining upward in their return on equity. Because of this, Johnson & Johnson is eliminated as a top performer. That leaves it to McDonald's and IBM. Adding IBM to the equation, you can see that clearly they didn't suffer much of a loss during the economic downturn. They have also experienced some very unusual gains over the past 9 years. While this may seem really attractive to investors, to me it indicates that I need to look further into the company's growth. That's exactly what I did. I examined IBM's return on equity by looking at all of their ratios over the past 9 years. And it showed me 2 very important things. Number 1, their return on equity was growing. However, it was mainly because their equity multiplier was growing at a very fast pace. The second thing is that their equity multiplier was already higher than average before, and it seems to just continue on a trend upward. The return on assets didn't supply much of this growth at all, and the little growth that it did supply was in its profit margin as they were decreasing their operating expense. However, their asset turnover had not changed at all in the past 9 years, which to me just shows that their return on equity is completely driven by them increasing their leverage and not increasing their asset turnover. And for this reason, IBM is out. Looking at McDonald's trends in return on equity, I wanted to get a better idea of their performance. So I looked at all of their ratios over the past 9 years, and it was obvious that their increase in return on equity was completely tied in proportion to their increasing return on assets. Their return on assets was driven by an increasing profit margin as well as an increasing asset turnover. Their equity multiplier was not showing any signs of trending up or downward and was staying about the same. There's two great things about that. Their equity multiplier is lower than average, and they're able to continue gains in return on equity without affecting their leverage. This shows you that McDonald's performance is based on quality and it has a sturdy foundation. And for this reason, McDonald's is clearly the top performer of the Dow 30. This just gives you an idea of McDonald's outperformance in the market. This shows you the 1-year returns. And this is showing you over 5 years, McDonald's has clearly performed better than the Dow average. Some highlights for McDonald's. Their economic value is just over $4 billion. Their market cap is at $88 billion. Their PE ratio is at 18.74. And their price, actual closing price on April 5th was $163, while the theoretical price given by the dividend discount model was $152, and the target price was $110, which means that it is undervalued and it is a definite buy. Because I do not want to base McDonald's great performance on only its competition against the 29 companies in the Dow, I want you to have a better understanding of how McDonald's surpasses other companies. So as you can see, I created an efficient frontier with return defined by return on equity and risk defined by beta. Once again, McDonald's is on the efficient frontier with 2 other companies and actually beats out the majority of the competition as it offers much higher return than those at its given level of risk, and even those with more risk. So clearly, McDonald's performance surpasses others. And this graph shows you McDonald's compared to the industry. Their market cap is much higher compared to the risk of others. It's pretty much on its own level. In conclusion, McDonald's is obviously my top pick for a number of reasons. It's proven its ability to recover during an economic downturn. Its growth is completely based on its quality performance. It shows promising trends upward and is continuously making improvements. Analysts suggest it's a buy, and I say it is too.